You're listening to Indications by the Conference Board.
This is Jonathan Liu. Welcome back to Indications. Today I'm speaking with Ataman Ozyildirim, Director and Global Research Chair here at the Conference Board. And our topic is oil prices. Obviously, this is a topic extensively discussed whenever anyone talks about the global economic outlook. Ataman, before we discuss what's going on with oil prices today, can you tell us what determines oil prices?
Well, Jonathan, as an economist like myself, I would answer that question by saying that supply and demand, of course. These are the fundamental determinants of any market price. But what is affecting oil supply and what is affecting demand for oil on global markets change over time, as well as their relative importance changes over time. For example, the emergence of the shale industry changed the landscape for global oil markets as more and more supply, especially from the US shale producers, came on board. However, some of that supply has not been easy to get to the ultimate consumers because bottlenecks and in the distribution networks really limited how fast they could get to consumers. On the demand side, the emergence of China on the global economy with its high growth rates and the high demand for energy inputs created a lot of demand for oil as well. Now, as China is entering a new phase of growth, a phase that our colleagues at our China Center in Beijing characterize as the long soft fall, that source of demand is fading away. It's taking off some of the pressure on prices.
So suffice it to say, it's complicated.
It is complicated indeed. So last week, the Conference Board gathered an expert panel to discuss these issues and to see where oil prices are going. We had a webcast, which I moderated. Oil prices is one of those evergreen topics that everyone is talking about when the topic of global economic outlook comes up. And where will prices go indeed? The answers are not so straightforward in a complex global economy. Not surprisingly, the WTI crude oil price had reached over $80 the day before the webcast, and then later receded back towards $70 the next day. This morning it was $75. In recent years, prices have been influenced by a range of factors, including changes in global demand, an upsetting of the supply of fossil and non-fossil fuels, and critical technological, societal, and political disruptions. Our panel of experts helped us to think through and disentangle the many factors which determine these prices and where they go next.
So we're going to play some clips from that great panel that you had. But before that, just in short, where do we think prices are going in the short term?
Well, in the short term, there's much more emphasis on the fundamental balance of supply and demand. But our experts also don't discount the potential volatility that originates from activities of the financial sector. So they do expect volatility. They do look at volatility closely, but they put the main emphasis on where demand is coming from and where supply is coming from. So while demand is keeping up, supply is going to come under pressure because there are upcoming sanctions that will be imposed on Iran by the US in November. So that is going to keep some supply off global markets. Both of these factors are going to point to oil prices remaining high in the range of $70 to $85. And even in the medium term, that same range is probably going to be keeping. We polled our audience during the webcast, and over half of our audience expected the same range, $70 to $85, but also a third expected some upward pressure. So let's listen to one of our experts, Mark Schwartz, Managing Director of Analytics at S&P Global Platts.
Despite the loss of Iranian supplies, we think that there's going to be a supply growth elsewhere that's going to largely offset that decline, both in non-OPEC and in Saudi Arabia and several of the other OPEC countries. So, we see a balance that can withstand losses of Iranian supplies and continued losses from Venezuela without the market being fundamentally undersupplied.
So, Ataman, the usual joke is that you put two economists in a room and you end up with 5 different opinions. We heard what Mark Schwartz had to say. Was there a consensus on the view that oil prices will remain at this elevated level?
Good point, Jonathan. But perhaps surprisingly, there was somewhat of a consensus. Even the lower end of the forecast was not really going below $60. So while no one was forecasting going back to three-digit oil prices, the high levels that we saw earlier this decade, a return to cheap oil is also not likely in the cards. Let's listen to Sarah Fowler, analyst on the international economy at Oxford Analytica.
The US sanctions on Iran's oil exports from November, we see that cutting at the moment oil supply, global supply by 1 million barrels a day or more, because neither the US nor Iran looks likely to make major concessions at the moment. We also see risks from the US hurricane season to hit US output in the near term. And similarly to the other guys, we also see Libyan output volatile and Venezuelan output is falling. That's going to continue to be a supply constraint dominating.
So we've got sanctions, hurricane season. What else did the panel bring up?
We talked about the role of the US on the world economy, as well as the role of the rest of the world, notably Saudi Arabia, which is still the swing oil producer on global markets. Also, the role of Iran, which is faced with these new international sanctions that clearly disincentivize global businesses from doing business in or with Iran. Then there are the big users, notably Europe, China, and India.
So beyond the projections of where the price will be, what is the state, like what does volatility look like in the market now? Is it especially volatile at this moment, or where do we project the kind of the peaks and valleys of oil prices in the years ahead?
There's a usual amount of volatility that we see in oil markets. It does make some people nervous, and volatility is an important factor here. If you don't have a clear idea of where your energy costs are going, you may not want to undertake significant investments. For consumers also, the price of gas at the pump has a direct impact on their wallets and their purchasing power. In addition to the supply and demand fluctuations and fluctuations in inventories, things like wars in the Middle East or geopolitical shocks can cause disruptions and volatility and nervousness. Also, natural disasters like hurricanes can also cause volatility. But another more important factor that we must mention is what the financial sector does and what they think about oil prices as they directly impact the flow of global trade and financing of those flows. Again, let's listen to Mark on what matters most.
Our view is you always start with the fundamentals. If you're in a world where supply growth exceeds demand growth and you're building up inventories, clearly you're going to have downward pressure on price and vice versa. But there is no doubt that for short periods of time, what the financial community does matters. We saw that back in 2008, where there were strong fundamentals, but probably not justifying $150 a barrel, which we saw at its peak. And yes, if the speculative community decides that they want to be long, for a short period of time, that can be the most important driving factor and can certainly lead to overshoots, perhaps, of where the fundamentals will take you. So yeah, we think that we keep a close eye on what the financial community does, and yeah, they also tend to be very sensitive to political risk development. So if the Saudis are a little bit slow in increasing production once Iran sanctions volumes are down, if Iran talks about retaliating against other suppliers, either directly or through their proxies, the financial community could react very quickly, and you could see a little bit of a spike.
In the medium term, we again go back to those fundamentals that will be more important determinants. As Sarah pointed out,
next year, I see demand as more important. And I think the risks could shift towards $60 oil being more likely than at the moment people thinking $100 as an upside risk. I think weaker trade and investment flows could dampen demand next year more than people are seeing at the moment, potentially.
In other words, supply is more likely to outpace demand in the medium term. And most of the new supply is coming from the US shale producers, which is a big factor that is likely to continue. Let's listen to Mark.
Well, it depends what you mean by role here. The U.S. has been the leader in supply growth, except in the year when we saw the price drop, in which case it led to decline. But as far as its role in providing incremental supply to the market, I think that's likely to decline over the next 12 months. We're already starting to see signs of infrastructure limits in getting oil from the Permian to market. You're seeing that as a discount on Permian price. And we think that problem will be addressed as additional pipelines are put in place, but that's probably not going to happen until towards the latter part of 2019. So we think, while the U.S. absolute supply will continue to grow, we think that rate of growth is going to be slower over the next 12 months.
I'm perhaps more bullish on the US output. Although OPEC's estimated to have 1.66 million barrels a day of spare capacity, it's not clear how quickly this can come on stream. I think once the hurricane season is out the way, the US role, although there are the problems with the Permian Basin and the delivery, I think the US has more potential to increase its production than perhaps Saudi and some of OPEC can definitely fill the entire Iran-shaped gap. So I would see the US role increasing modestly.
I also asked our panelist Timothy Goodell, Senior Vice President, General Counsel, and Corporate Secretary at the Hess Corporation, about the role of the U.S. on global oil markets. There are probably two elephants in the room when it comes to the U.S. role in determining global oil prices: the oil frackers, shale producers, and the administration's desire to keep prices low. How does he weigh those two factors, and what else comes into the mix? Tim?
Longer term, obviously, as Mark said, the economy is very strong. That's obviously a positive thing for oil prices. Fuel prices are very affordable. If you look at today, I think 42% of the cars that are sold today are SUVs. They're not the fuel-efficient cars. So that bodes well for oil prices. But then the oil has a huge impact on the economy in the United States over the last 10 years. So there's been about $600 billion of investment from oil companies alone. It's employed directly and indirectly over 10 million people. So that's a huge impact on the economy. The trade deficit, because of the oil exports today, has had a huge benefit for exports, for the trade deficit as well. So overall, the stronger economy, the better the oil prices are within a stable range. I mean, we look for, oil stability, which is best for, we think, the oil companies because it encourages investment, but it's also good for the economy.
Are there any specific risks brought up by the advent of the shale industry here in the U.S.?
Well, there are those that are concerned about the health of the shale industry in the U.S. It's a new business model, and some companies have been heavily reliant on debt financing. There's a new book by Bethany McLean, Saudi America.
And we'll put a link in the show notes.
Yeah, I actually did a double take on that. The title of the book is Saudi America. And she argues that fracking could actually become the next trigger for a crisis.
And we have a clip again from Mark speaking to that point.
Yeah, here's Mark's thoughts.
There is certainly a grain of truth there. It's a diverse industry. There may be some companies that are financially weak, that are over-leveraged. But this industry has evolved quite a bit over the last couple of years. 2 years ago, I might have been a bit more worried when prices were lower, when companies seemed to be driven by cash flow as opposed to, by volumes rather than cash flow and profitability. But a lot's happened over the last year. For one, the price has gone up. And I think when people talked about break-even prices in the low 40s for U.S. shale, I think to some extent those were well break-evens and really were not, those were not prices that would keep a company in business, covering all of their overhead and land acquisition and other costs. We think the break-even was always fundamentally higher than that. But at $60 a barrel, we believe that the industry will show positive cash flow this year. So, anything above that is is going to allow them to pay down debt a bit more. Yes, it's true that we do have these very high decline rates for the first couple years, but we also have a long tails on these wells. At least we believe we have long tails on these wells, so that over time you've got maybe 10% of the original production, but with very low costs associated with it, that should be a positive contributor. So I think it's while it's true that we've got high decline rates, if you're looking at the fundamental health of the business, you've got to take into account that a lot of cash is going to be thrown off eventually by those tails as well. So yeah, I mean, we would have been more worried about this a couple years ago than we are now. There's been restructuring in the industry. Some of the smaller players are gone. More of the acreage is in the hands of fundamentally sound companies. So while there'll be sporadic problems, we don't see the industry as being fundamentally unprofitable.
Well, again, that is a lot to take in. Thank you, Ataman, for giving us this great update on oil prices. We'll put a link to the full webcast in the show notes. Thank you, Ataman.
Thank you, Jonathan.
This has been Indications from the Conference Board.